wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And the way we do that is by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 202, and in this episode we are reviewing the performance of the financial markets during the 9th week of 2026, and that is from Monday the 2nd to Friday the 6th of March. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the Middle East, where the United States and Israel continued their airstrikes on Iran on Saturday, 1 week after they launched their joint campaign to rid Tehran of its nuclear and ballistic missile capabilities, whilst also pushing for a regime change. Tehran's energy-rich neighbors in the Gulf said they had intercepted more missiles and drones from Iran as the country's president reportedly apologized for the attacks. And back to the United States, where the Bureau of Labor Statistics reported on Friday that the U.S. economy lost jobs in February, a month marred by severe winter weather and a strike at a major healthcare provider. Nonfarm payrolls fell by 92,000 jobs in February, compared with an estimate for 50,000 jobs, and below the downwardly revised January total of 126,000 jobs. February marked the third time in the past 5 months that payrolls had declined, following a sharp revision showing a sharp drop of 17,000 jobs in December. At the same time, the unemployment rate edged higher to 4.4%, as jobs declined across key sectors. And over to China, where the Chinese government has set itself the lowest growth target since 1991, acknowledging domestic challenges and pointing to global uncertainty, whilst keeping some stimulus measures in place in order to counter the possibility of any external shocks. On Thursday, China announced its GDP growth targets for 2026, which it set within a range of between 4.5% to 5%. This lower target range leaves room for policymakers to react to the external environment, which has seen increased uncertainty so far this year. And in the Eurozone, inflation increased unexpectedly in the month of February and may rise even further in the coming months if the war in the Middle East keeps energy prices high and could put pressure on the European Central Bank to revisit its current policy stance. Data from Eurostat that was released on Tuesday showed that inflation in the 21-member trading bloc jumped to 1.9% in February, up from 1.7% in January, outpacing expectations for a rate of 1.7%. Meanwhile, the underlying or core inflation, which excludes volatile food and energy prices, this increased to 2.4% in February, up from 2.2% in January, as services inflation once again accelerated more than predicted. On Wall Street this past week, stocks fell on Friday, adding to their weekly declines as oil prices spiked and traders reacted to an unexpected decline in the latest U.S. jobs report. Equities were also bogged down by the latest jobs report as investors contemplated the duration of the ongoing war in the Middle East and its long-term impact on oil prices, which just broke above $90 per barrel during the first week of the war. The Dow Jones Industrial Average lost 453 points to end at 47,501, whilst the S&P 500 fell by 1.33% before settling at 6,740, and the tech-heavy Nasdaq Composite dropped by 1.59% to close the week at 22,387. And in the government bond market, the yield on the 10-year Treasury bond slipped on Friday, though its loss was contained as investors assessed the likely impact of inflation resulting from higher energy prices and related to the ongoing war in the Middle East. The negative jobs report and the higher price of crude oil are sending mixed signals and have put the Federal Reserve in between a rock and a hard place. And that is because significant weakening in the labor market should support a rate cut, but the risk of higher oil prices could trigger another bout of inflation, which may compel the Fed to hold back on further rate cuts in the short term. According to the CME's FedWatch tool, the possibility of a 25 basis point rate cut coming as soon as July increased slightly to 43.4%, and this is compared with a 38.9% likelihood that the Fed will opt to keep interest rates on hold. The spread between the 2-year and the 10-year Treasury widened to more than 58 basis points, which might reflect higher expectations of future inflation. The yield on the 2-year Treasury note was down by more than 4 basis points at 3.55%, whilst the yield on the benchmark 10-year Treasury bond fell by less than 1 basis point to settle at 4.13%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil posted its biggest weekly gain in futures trading history as the escalating war in the Middle East triggered a major disruption to global oil supplies, causing the price of crude to spike above $90 per barrel and stoking renewed fears of inflation. Iraq has shut down its production of 1.5 million barrels per day, as Kuwait also started cutting production after running out of storage space. Production cuts could approach 6 million barrels per day by the end of next week if oil tankers are still unable to pass through the Strait of Hormuz. The global benchmark Brent crude jumped about 48% for its biggest weekly gain since April 2020 before settling at $92.69 per barrel. Meanwhile, U.S. crude, that is West Texas Intermediate, soared by 35% for the biggest weekly gain dating back to 1983 as it eventually came to a close at $90.90 per barrel. In the precious metals market, the price of gold rose on Friday after a negative U.S. payrolls data pointed to further rate cuts by the Federal Reserve. Nevertheless, gold remained on track for its fast weekly decline in the past 5 weeks as a stronger U.S. dollar kept gains in check. A weak payrolls report that saw heavy job losses in the private sector along with higher wages all point towards stagflation. Fed policymakers are scheduled to meet on the 18th of March, where they are widely expected to keep interest rates on hold, with a faster rate cut expected in July, as per the CME's Fed Watch tool. The price of gold is up by more than 18% so far this year, but the price of spot gold was actually down by 2.4% this past week as it came to a close at $5,149 per ounce. In the cryptocurrency market, President Donald Trump has thrown his support behind crypto firms in their high-stakes battle with U.S. banks over whether they can offer interest-like returns on stablecoins. In a social media post late on Tuesday, President Trump increased the pressure on banks to relent on the issue of introducing a yield for stablecoins. This is the main point of contention that is holding up the passage of the Clarity Act in Congress, which is a companion bill to the Genius Act that was approved last year and provided the framework for the regulation of stablecoins. We now change scene to the Kenyan financial markets. And we start by looking at the domestic foreign exchange market, where the Kenya shilling continued to trade within a very narrow range versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.20. Meanwhile, the sterling pound was priced at 172.72. and the euro was valued at 150.42. And on the regional front, one Kenya shilling was changing hands for 28.52 Ugandan shillings and 19.85 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.28. The IMF has previously raised concerns about the extreme stability of the Kenyan shilling, but the central bank insists that it continues to operate a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by a whopping $2.06 billion for a grand total of $14.59 billion, which is equivalent to 6.2 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The massive increase in forex reserves was attributed to the recent issuance of a dual tranche Eurobond for $2.25 billion, part of which was used to buy back existing Eurobonds that are approaching maturity. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.72%, which is in line with the revised central bank rate at 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 57.9 billion shillings. And just for your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 5th of March, and the central bank received bids totaling to 100.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 418%. The central bank ended up accepting about 41.4 billion shillings, and the results of the auction were as follows. The 91-day rate was broadly flat at 7.57%, whilst the 182-day rate rose by 2 basis points to average out at 7.82%, and the 364-day rate declined by 14 basis points for a weighted average rate of 8.64%. At the Nairobi Securities Exchange, the equities market was on a downward trajectory, with the NSE 20 declining by 3.9%, whilst the all-share index declined by 3.5%. This takes a year-to-date performance to gains of 14.8% for the NSE 20 and 11.2% for the all-share index. The market's performance was mainly driven by losses recorded by large-cap stocks such as Absa Bank, Standard Chartered Bank, and NCBA Bank, which declined by 6.4%, 6.1%, and 4.9% respectively. This performance was, however, supported by gains recorded by other large-cap stocks such as Cooperative Bank and DTB Bank, which increased by 2.7% and 1.5% respectively. Staying at the exchange, Kenya's commercial banks grew their pre-tax profit by 20% in the year ended December 2025 to pass the 300 billion shilling mark for the first time, signaling higher dividend payouts to shareholders. Disclosures from the Central Bank of Kenya shows that commercial banks posted a pre-tax profit of 311 billion shillings in 2025, up from 260 billion shillings in 2024. Up next is our topical issues, and this week we're looking at the following three issues. The first issue is on the Kenya Pipeline IPO, where domestic retail investors, foreign investors, and oil marketing companies opted to stay away from the oversubscribed Kenya Pipeline initial public offering that was saved by Uganda and local institutional investors. The offer received a 105.7% subscription rate, raising 112 billion shillings against the state's target of 106 billion shillings. However, the success of the IPO was masked by apathy among foreign investors, retail investors, and oil marketing companies who still consider Kenya Pipeline a strategic investment but disagreed on the valuation of the IPO. The government had priced the IPO at 9 shillings per share, which was in sharp contrast to independent sources who had valued the company at 4 shillings and 61 cents per share. Records provided by the Treasury Cabinet Secretary showed that domestic retail investors bought shares worth 4.1 billion shillings against their allocation of 21.2 billion shillings, whilst foreign investors spent a measly 34.8 million compared to their allocation of 21.2 billion shillings. Meanwhile, oil marketing companies took up shares worth 23.1 million shillings out of the 15.9 billion shillings worth of stock that they had been allocated, representing a dismal uptake of just 0.14%. The second issue is on global banks flagging debt and drought as risks to economic growth. The rising cost of servicing the public debt and unpredictable weather patterns have emerged as the biggest threat to Kenya's economic growth in 2026. The February 2026 Focus Economics Consensus Focus for Sub-Saharan Africa, which is based on feedback from 12 global banks, consultancies, and think tanks, indicates that Kenya's economy is likely to expand by more than 5% in 2026. The consensus report projects that the economy will expand by 5.1% in 2026, up from an estimated 4.9% in 2025, placing it above the sub-Saharan average economic growth of 4.1%. Economists say that the acceleration in Kenya's gross domestic product is being underpinned by easing inflation, lower interest rates, and resilient domestic demand. Kenya's growth prospects, however, trails neighboring countries such as Rwanda, which is focused to expand by 7.1%, Tanzania at 6.1%, while Uganda is projected to grow at 6.8%. And the third issue is on Kenya's Eurobond debt, where the stock of outstanding Kenyan Eurobonds has grown by 236 billion shillings after the country's latest issuance, revealing growing liabilities from sovereign bonds, even as the National Treasury emphasizes its focus on cheaper financing. Kenya's total Eurobonds rose from $8.78 billion to a high of $10.61 billion, and this is after the sale of a dual tranche Eurobond for $2.25 billion in February 2026. The first tranche of this bond is a $900 million bond that is priced at 7.875% and which matures in 2034. The second tranche of the bond is for $1.35 billion and has a coupon rate of 8.7% and matures in 2039. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhurij@gmail.com. And once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, success is not final. Failure is not fatal. It is the courage to continue that counts. A quote by Winston Churchill. Think about it. Thank you, and God bless.